Good morning. I welcome you all to the investors call of Apollo Finvest India Limited. This is the third quarter, and we'll be discussing the financial results, the what and not going on in the company for the third quarter for December 2023. We'll begin with Mr. Nikhil Inani addressing our investors, and post that Ms. Diksha Nangia, our CFO and whole-time director of the company. Meanwhile, I would request you all to drop your questions in the Q&A section. Nikhil, would you like to take over?
Yes, thank you so much, Prachi, for setting this up, and very excited to meet all of our investors. And as we like to do in all of our investor calls, this is largely about you guys, and obviously we will be sharing some updates about the company and some of the interesting stuff which has been going on, and talking about some of the stuff that we said in the last investor call, and how we are seeing that actually happen in the quarter that we're talking about, right? Which was a lot of the stuff that we said in Q2 actually is happening in Q3, so that's quite exciting. Those things. So, like Prachi said, any specific questions, please. We will be sharing some updates after we largely just interacting with you guys and our in where we are headed, because internally at least we are very, very excited about how things are shaping up to be, and we expect obviously future quarters to as well go. So basically, without any further ado, let me maybe switch it to Diksha, and we'll take it from there.
Yes, thank you for that, Nikhil. Morning, everyone. What I'll be doing is I'll just give you a quick update of what we've been up to in the past quarter. I think Nikhil has given you some sort of introduction. Maybe he can elaborate on all the points I'm going to tell you right now. So those few quick updates for what happened last quarter. I'm sure you've realized our AUM has gone up 3 times. And what we've been doing this past quarter is we've actually given a lot of term loans to NBFCs. A lot of partnerships with NBFCs have happened per se. One thing we realized is post these guidelines, a lot of regulated entities are what we realized we could scale with. And in whatever fashion we could establish partnerships with them, be it in the form of a term loan or in a co-lending fashion, co-lending being the long-term play here. We've started to establish those contacts in this quarter. And this is why you're seeing, a bump up as far as our AUM is concerned. We're hoping and expecting that number to increase in the coming quarter also. I'm sure you've noticed our revenue has not increased to the same degree that it was expected to, considering our AUM. But that's primarily because our AUM increase just happened in the middle of last quarter. So we're hoping to see the fruits of those come in the coming quarter also. Another thing we've realized is that, of course, post the guidelines, it's only better and more scalable for us to work with regulated entities. And that's been our endeavor in this quarter and even the coming quarters. We feel they're more seasoned players. They know how lending works better than maybe LSPs. Not that we won't be working with LSPs. There are a lot of good, amazing LSPs out there also we're still currently working with. But it's just that it's a more scalable option for Apollo to work with NBFCs rather than only work with LSPs, which is what we were doing in the past. So that's one shift in the way we've approached our lending. But one thing I can tell you for sure, after having worked with so many regulated entities in this past couple of quarters, is that we realize, and it's doubled down on our thinking that tech is definitely our key strength here. And we've realized that a lot of NBFCs find it very difficult to start partnership with other regulated entities that are not very strong when it comes to their technology. But clearly Apollo's key strength when it comes to tech is helping us out there. It's helping us start our partnerships way faster. It's helping us scale better because a lot of teething issues happen. Both systems have to be integrated. Just to give you a more detailed overview of why systems need to integrate is because in a co-lending arrangement, both NBFCs need to have the same loan aligned on both ends. And that's where we realized that our tech and our systems are really helping us make this partnership run smoother. So clearly, what we've been building from a tech standpoint is helping us. And to double down on that, we are also expanding our tech team. We're hoping to have a lot of new members join our tech team in this coming quarter also. Um, the next update is from a hiring update because that's the next big thing that will be happening this quarter. I know we always talk about hiring as an update because that's a continuous thing for us at Apollo. But another key differentiator this quarter would be that we're targeting a lot of senior folks to join Apollo. We realize that our industry has reached a point where there are already people who've been there for the past 6, 7 years that the fintech space has been around here. And we realize that we can now hire people from this space already who've been there and done that. And we want to use that experience that people have had in the industry to take Apollo to the next level. So yes, these two key updates. I think I'll let Nikhil elaborate on them further, and then maybe we can start with the Q&A. Thank you so much. Thanks.
Right. So that was a good, I think, overview from Diksha on a lot of stuff which is happening. Obviously, the exciting stuff, just to highlight it again, is basically number one, the AUM ramp up, which I think we had also spoken about, in the last quarter as well, right? That we had mentioned that now the time is kind of up for us to taking it slow. We were expecting a large ramp up, and I think some part of that I think has already happened with obviously the 3x jump in AUM. I think in the coming quarters as well, we will continue seeing a decent rise in our AUM. I think all that kind of goes down to basically a lot of the legwork which has already been done in establishing some of the really solid partnerships that we have right now with some of the best lenders we believe which are there in the ecosystem. A lot of them fit the kind of criteria that we have, which is people who are basically already lending at scale, know what they're doing by actually us being able to thoroughly examine their financials and making sure that they have the same ethos as us in terms of the unit economics to be very, very simple, right? Like looking at other profitable NBFCs that we can work very, very closely with, who value tech as well, and that makes us into a perfect partnership from both perspectives, right? And this is what happens essentially. From our perspective, we've kind of noticed that because of obviously the amazing technology that we built, it gives us a lot of priority in terms of getting them as partners, and at the same point in time, it gives us pricing power as well to not only obviously get attractive rates for the technology that we've built, but also the capital that we're providing, and also puts us in front of the kind of people that they want to kind of do integrations with, because obviously in the tech space, right, time is critical, right? Go to market is critical. People don't have the patience to kind of wait for like 5, 6 months, 7 months to kind of get into integrations and make sure all systems are kind of going. People want to do this in a couple of weeks, right? If they can. And if and when that happens, it really, really kind of changes the game from their perspective, because it really almost like, gives them exactly what they want from a partner, right? And a partner who's technologically very, very strong makes that relationship that much more sweeter. So our ability to go fast and provide amazing technology continues to obviously be a very, very important factor for us. The second big thing I think, which obviously Diksha mentioned again, is I think a lot of the team members that we have right now are fantastic for us in terms of, getting us to where we are today. And I think they will obviously continue contributing extremely heavily to, whatever success the company is going to have over the next, many years, right? But I think for us to go from being a good company to a great company, right, which is what we really want to do, I think we now need to hire, in my opinion, 2 to 3, people, across the company, across different verticals, and try to look for people who, can help us basically go to the next level, right? And from a next level perspective, I'm looking at, people who obviously have relevant experience, but at the same point in time, I think now is again the right time to do this, because very honestly, we couldn't do this, a few years back, right? Because at that point in time, if you were looking to get, quote unquote, experienced people into the company, you would largely get people who have traditional financial services experience, which obviously has its pros, but I think it has a lot of cons, which is basically, it puts people into kind of a traditional way of thinking. And if that's their career, it's very difficult for them to break out. I think given the fact that, digital lending has matured, and now, it's been almost 7, 8 years since it's been pretty active, it's been a pretty active space, right? I think what's really happened is a lot of people have by default educated themselves really well in this field over the last 7, 8 years, right? So, I feel like very frankly, right now is a good time for us to dive into this space, and see if we can, get some really good talent on board with relevant experience, with a very clear mindset and understanding of, what the present and the future of, digital lending can look like, right? And really basically help us, go to the next level. So yeah, these are the 2 big things at least which come to my mind. One is again the AUM, bump up, which I continue to foresee, for the quarters coming ahead, and at the same point in time, fortifying the team with some, 2 or 3 key hires across the board. These are the 2 big things that I kind of, see going forward. Now I'll kind of pause, right? I'll pause, and we will kind of address many of the questions now, so that you guys get a chance to actually ask whatever it is that you want to, and we can take it from there.
Thank you, Nikhil. Thank you, Diksha. That was very insightful. We'll be moving ahead with the questions. We have questions from Mr. Nitin. Mr. Nitin, I'll be unmuting you so that you can ask your question yourself. Mr. Nitin, you can unmute yourself and ask your question.
Hello. Am I audible?
Yes, go ahead.
Hi, Michael.
Hey.
Now, Michael, once in a time you have said that Swiggy and Zomato is using our platform for digital disbursement of loan or for their digital partnership. Is this still in place?
No, that was an example that we had given. And at any point in time, Zomato and Swiggy have not been using our platform. But this was just an example of, I would say, platforms that, we envision will inevitably get into digital lending. Because again, I think the thesis that we've kind of mentioned on our blog is, I think, stronger than ever today, where, more and more companies are thinking about unit economics very strongly. And if you don't basically, put finance into these platforms, right, I think they will kind of struggle to get to the kind of profitability numbers that, I think all the investors today, expect them to be. Should we go to the next question, Prachi?
Yeah, let's move ahead. I'll be unmuting Mr. Puneet. Mr. Puneet, you can unmute yourself and ask your question.
Hello, can you hear me?
Yeah.
Yeah, my first question is why we are listed only on BSE and not on NSE?
Yes. And any other questions? I'll answer both of them together.
Yeah. In your annual report, I see a purchase of a residential property amounting 2 crore 75 lakhs. So I want to know the reason why we have purchased this property. And last question is where we can find the AUM number you are talking about.
Got it. So I think to answer your first question, why BSE and not NSE, I think the answer is pretty simple. I think we had listed the company's been listed since I think almost 30 plus years at this point in time. So I think at that point in time the BSE was a lot more popular than the NSE. So I think back then, very frankly, I think that's how my dad decided to do that. And ever since then we've been listed on only the Bombay Stock Exchange. So I think that's some perspective on that. I think to answer your next question regarding the flat, right? I think this is more to do with you know basically I think this is not something which is a recent transaction, at least to my knowledge. This must have been a legacy transaction, which is almost honestly prior to me and Diksha basically running the show, right? So I think it may be something to do with that. But one of the things you must have noticed over the last 6-7 years of us doing this, right? What are the legacy transactions we have? We have been liquidating all of these all of these assets over a period of time, because our business is very, very clearly wholly and solely only into digital lending, right? So if there are assets which are remaining at this point in time, uh, I foresee over the next few years, as and when we get the opportune time to exit them, you will see those exits happen and that money being deployed towards lending. So that's a little bit about that. I think to answer your question regarding the AUM, right? You should be expecting this, expecting the exact numbers by sometime next quarter, because I think the balance sheet has not been updated this quarter, but next quarter, the AUM will become, publicly available. So that's how you can think about that.
Okay, thank you so much. Can I ask one more question?
Yeah, of course.
Yeah, in this quarterly report, I see that fee and commission has been reduced as compared to previous year quarter. So did
Yeah.
we lost some clients or what's the reason?
I think the reason is what we kind of mentioned in the previous quarter as well, right? Like a lot of the stuff that we are expecting right now is that, we're deploying a lot of our capital. So essentially what happens in this case is that when we deploy a lot of our capital, I think the interest income is, rising in exchange of that, right? So I'll give you an example of sometimes, what can be included in, fee and commission as well, right? Sometimes partners, because when they work with us, right, they have to make like a 12-month commitment with us, and in these cases sometimes they commit for capital which they may not be able to utilize, but in that case they end up paying us fees, right? So that comes under fee and commission. But at the same point in time, if those partners end up utilizing the capital, right, like which is actually us blending together, that actually comes up in interest. So if anything, I think it's a sign that all of our partners are, going all guns blazing and basically, actually lending very strongly with us, where, most of the income which would have come in fee and commission is now coming as interest income, because that shows that, partners are um, basically properly live with us and utilizing the capital that they've committed, to utilize, rather than, just signing agreements and being in a situation where because they committed for capital, they're just paying sometimes the commitment fees for it.
All right. Thank you so much. That's all from my side.
All right, thanks, Puneet.
Thank you so much, Puneet. Moving ahead, we'll be taking questions from Mr. Matthew. Mr. Matthew, you can unmute yourself.
In the last call, you were telling, right, maybe for future you might take debt from the other institutions, right, to scale up. And in this one, I mean the P&L, I've seen interest expense as one of the expenses. So have we reached that state that our capital is completed and we have started taking debt from other, let's say, banks or NBFCs to scale up our business?
Not yet. I would expect that to happen extremely soon, though. So, that is going to be a very pertinent conversation, for us pretty soon. Right? I would expect probably in the next 3-4 months that an important, basically, question to kind of, important important item on the agenda, basically, right? Because I think the speed at which the AUM is rising essentially, and I think it's all a function of all the hard work which has been done, I think, in the last couple of quarters to get us in a position where we feel we have very, very positive partners with whom we can scale up in a unit economics positive manner, right? I think all of those benefits we're going to be seeing. I think we started seeing that, very frankly, even just to comment a little bit on the revenue and profit numbers, right? I think Q3, I think, is just a sign of what's to come in quarters ahead, because I think realistically the ramp up also happened very much towards the end of the quarter, right? Probably in month 3, to be very honest, right? So I think we only saw some kind of benefits, right? Very small amount of benefits in terms of the bottom line in Q3, right? I think a lot of the benefits we're going to be seeing in Q4, and I think Q4 will also be a good place for us to basically see a further rise in AUM essentially, right? So I think all of those things basically mean that I think pretty soon we should be deploying more or less 100% of our equity, and starting to absorb some external debt as well pretty soon. So yeah, I'm expecting that to happen very, very soon.
Thanks, Nikhil. But I see an interest expense component in the expenses, right? That's why I was asking, what is that interest expense component? And also, is there any way that you can add the AUM also, like somewhere in the P&L? Like I see it always from the LinkedIn post that you share, right? I mean, is there any other way that you can add? These are 2 questions. I mean, what was that interest expense, and can you share the AUM also in the official documents?
Yeah. So I think the interest income, right, that's the interest on
interest expense.
Yeah, that's on the income tax, right? Basically, we have paid short-term or short advance tax, basically, right? Paid short advance tax. That's what we basically essentially done. And on the AUM front, what we expect essentially is that, again, in Q4, right, that will show up in the balance sheet. Sometimes we purposely don't, essentially, in the middle of a scale up, we don't want to share these numbers, right? Once it kind of stabilizes, we'll be more confident of sharing that. It's difficult to share that in the middle of a ramp up, because the number that we share at this point in time won't really be accurate of where we are even today, because largely we're expecting those numbers to rise essentially, right? And during this point in time, sometimes what happens is, because there's a ramp up, and at the same point in time we're doing a lot of commercial negotiations with our partners, we really don't want them to know what part of our AUM is with them, to be very honest, right? So that's a little bit of smoke and mirrors, which helps our company in doing these negotiations. But I think again, to answer your question specifically, right, I think expect in Q4 for us to display exactly what our AUM is, and that will kind of display automatically on the balance sheet as well.
Thank you.
Sure.
Thank you so much, Mr. Matthew. Moving ahead, we'll be taking questions from Mr. Raghav. Mr. Raghav, you can just ask your question, unmute yourself and ask your question.
Hi, Nikhil. So, first part of my question has been answered. I think we can expect ramp up in the numbers Q4 onwards. Last call, you said you have your own funds about 50-60 odd crores, which will be utilized. So I want to know a sense of how much we have utilized, how much we are left with, and any plans for the fundraising. So right now, if we say in 1 quarter, our AUM has gone 3x. So do you see same speed going on, or you think that it will slow down and we'll probably settle somewhere around 6x or 10x? Just some sense on the AUM growth and the amount of capital at hand.
Yeah, I would say that essentially, without diving into like, actual numbers, right? I think probably a fair estimate that I have is I would put it in this way, right? I would expect that in the next maybe maximum of 3 months, I would expect that for us to basically deploy all the equity that we have, right? Like that's realistic expectation that, internally we have, and that's the kind of targets that we have set for ourselves, right? There are ambitious targets, but we expect them to be met, right? That's how we primed everything towards. So that's to answer, I think, your first question. I think to think about how do you, on the capital front, right? I think our first immediate goal is going to be after that to get, leverage into the company, right? So yeah, just to be, categoric on that, like we're not looking to basically do any kind of equity injection into the company at this point in time. It's way too early. Our valuations are, I think, very, very modest at this point in time. So I think we have a long way to go. So I think the right way for us to go about doing this will, be first, obviously, over the next, 2-3 months, get all of our equity deployed. Second, get to, some kind of leverage, essentially, minimum anywhere between, 1 to 2x, debt to equity, right? Which is, I think, a fair expectation to basically have. And then take it as it comes, essentially, right? Like at that point in time, we'll see what's the best capital which is required for the company. Given that we're also, I would say decently profitable from an ROE perspective, we will be very, very smart about the kind of capital we take into the company because, again, for us, it's very important to grow sustainably with really good return on equity, rather than, building a company which, is giving ROEs which are basically reflecting, sometimes, other companies which give ROEs which are, like FD rates, right? Or sometimes even below that. So that doesn't really, make sense to us. So we'll be very, very smart about how to take capital inside the company. But yeah, the focus will always be on delivering like really good ROEs.
Thanks, Nikhil. And how about the profit margins? So, any range that you have in mind based on the unit economics we have? I think last time you said it will be in higher teens. So, are we saying it will be around 18 to 25% or more than that?
I think nothing really changes in terms of, what I had mentioned last time as well. I expect that to continue happening, and hopefully, our goal is that as we kind of scale up even more, the margins expand, right? Because obviously, when I think about obviously APIs, right? Like the more you use them, obviously the cheaper it becomes for us, and that's where our margins expand further. And I think even when it comes to capital, right? The more capital that we end up raising, obviously there will be additional NIMs that we get from it. So, and obviously the bigger that we get, the cheaper the cost of capital ends up becoming for us, right? So a lot of those things, will come into, fruition, and obviously will be extremely beneficial in terms of margins.
Thanks, Nikhil.
Welcome.
Good luck.
Thank you.
Thanks, Mr. Raghav. Moving ahead, we'll be taking questions from Mr. Mukesh Kothari.
Hello. Audible?
Hey, Mukesh. Hi. Yes,
Hi.
absolutely.
Yeah. Just want to understand one thing. What led to the change in the thought process of moving away or pivoting away from LSP model to, say, lending, co-lending model with NBFC? I mean, what are the challenges do you see in LSP model? And what would, would the focus be reduced on LSP led model that you have today?
Yeah, that's a great question. I mean, honestly, I'll tell you, we've been in this space like almost for now 6-7 years, right? And really, the thought process that we have at this point in time is that, finally, like from an RBI perspective, I think it's to us at least, it's very, very clear that, they see this space as something that they want very, very tightly regulated. So I think it comes to, it comes to basically not only seeing what the guidelines have been kind of hinting at, but also kind of reading the tea leaves about what we expect to happen in the future, right? So, like, very honestly, if you ask me, I expect that over the next, maybe 3-4 years, right, the largest digital lenders in the country are going to be people with licenses. Like, this is something which, we internally very strongly believe. I think if you're an LSP, the right move at this point in time is to try and acquiring a license, right? Because that's going to be, or that is, in my opinion, a very, very fundamental pillar. So I think it's nothing, I wouldn't put it in some way that, I don't think it's I don't think it's the end of LSPs at all. It's not that. It's just that from our perspective, right, given that we are looking to scale essentially, right? And why are we looking to scale? Because I think we have all of the information that we need from an underwriting perspective, from an evaluation of companies perspective, to the collection infrastructure that we need for this to be the right moment. And also what's happened is there's been a lot of consolidation in this space over the last, again, 12 to 18 months, given all the regulatory action. And very honestly, a lot of investors have not shown a lot of support towards LSPs, right? All our action is moved towards NBFCs. So because of all of those things, right, like essentially the people who are actually looking to scale are also NBFCs. And the beautiful thing about working with, regulated entities is, number one, their core business is lending, right? So obviously, their intent is a lot higher. And number two, because they are licensed entities themselves, they are very, very, they keep compliance to be very, very important. And at the same point in time, because, when you do co-lending, the biggest advantage is, the loans are on both our books, right? So by default, it really, really fortifies, the mentality in terms of both of us wanting to do a really good book, right? Because lending is pretty simple, right? You give out money, you get back money, and as long as you do that really, really well, somebody comes and gives you money, at a cheap cost so that you continue doing this and scaling up, right? So I think when you work with other NBFCs who have that same mindset, they want to basically do things right. They want to create a really good book so that their book is really nice, our book is really nice, and both of us are profitable, right? Because again, if you're an unprofitable or a low ROE NBFC, I think either you will struggle from a debt perspective or either you will struggle from an equity perspective, right? So I think a lot of those things are coming together. And at the same point in time, I think what we've been able to do is, through the brand that we've created over the last 5-6 years, or actually at this point in time, 7-8 years, right? How time passes. But the reality is that, because of the credibility and brand that we have out there, I think everybody at this point in time, whether it's an LSP or an NBFC, wants to work with an Apollo largely because they want the great experience that Apollo offers in terms of tech, the fast go live, etc., right? So all of those things are helping us to pick and choose amongst the best in the best in terms of business, right? And when we're able to do this, it just makes a lot more sense for us to go in with, really large NBFCs out there in the digital lending space who have proven themselves over the last, 3-4 years, delivered like profitable years across the last 3 years, right? Maybe their ROEs aren't, close to what ours are, but, sometimes I can discount that, because of, I guess, their, cap table wanting different things. But, one of the things I find it very difficult to kind of discount is if, you're building a lending company, which is, unit economics negative and not profitable, right? So I think we've been able to actually find a lot of companies which have been in this space and have been performing, decently well over the last 3 years. Again, the standards being that of, a digital lending company, right? And all of those factors coming together, largely the best teams that we've been finding, the best companies that we've been finding have been NBFCs. And the beautiful thing about them is because of their focus on creating really good books and being compliant about it, and their focus being again 100% on lending, we just find them to be the most suitable partner at this point in time. And combining that with what RBI thinks, I think the future seems to be heading definitely in this direction.
Fine. I understand. So, what sort of model are you looking at? I mean, is it distribution-led model or co-lending model? In the sense, I'm just trying to understand because if you are doing the co-lending, then you are I mean, if you're doing distribution, then your margins would be less, and if you're doing co-lending, your ROEs would be less. And what sort of NBFCs are these? I mean, are these listed, unlisted? I mean, if you can give a color of what sort of NBFCs are these NBFCs? I mean, are they into, say, personal loan lending, unsecured lending?
Yeah, absolutely. Right. So number one, I would say, pretty much all of the NBFCs that we work with are absolutely, tech first in nature, right? So I'm not talking about any legacy NBFCs at this point in time. The DNA remains exactly the same in terms of the kind of partner that we want. We look for only companies which are tech first companies because, very honestly, only if you work with tech first companies will they kind of value tech at the same point in time, right? If you work with like a legacy NBFC, I think given, their own internal DNA, uh, being very manual in nature or working in a particular style, right? Like I think very honestly, even if they looked at uh, Apollo's efficient infrastructure, right? Like I think maybe they would not value it, right? Because only when you know the problem do you value the solution, essentially, right? So I think that's why for us the focus remains exactly the same. These are all like tech first NBFCs that we are kind of working with, and they're the ones who honestly, love working with us as well. Like, recently we onboarded somebody who, today literally has worked with like 15-20 different NBFCs, right? And they're an NBFC themselves. I think they're systematically important as well with 1,000 crore plus AUM. And they literally said that, working with the Apollo and co-lending with you guys was the best experience I've ever had with any lender, right? And this person literally has the pick of the bunch, right, in terms of working with anybody. And at the same point in time, uh, the portfolio that they've created with us is the best portfolio they have across the table, pretty much, right? And by any means of imagination, Apollo's far from the cheapest, right? And the reason being very simple, right? Essentially for them, it's not just about cost, it's about delivering a great user experience to their best customers, right? Because there's no point delivering a crappy experience to your best customers because, finally money is a commodity. And, if you don't give a good experience, this guy is going to take his best customer to another lender, right? Or the best customer itself is going to leave this guy and go to another, digital lender, right? So they want to make sure that they're servicing these customers really, really well. And that's why they want a really good co-lending partner for that. So definitely our focus, by the way, to answer your second question is, it is on the co-lending model. That's our big focus. Uh, you know, I think that's where we can basically unlock a lot of those benefits where, the loan is on both books so that, it's important really for both people to keep really, really clean books. And by default, that results in a much better portfolio from a DPD perspective. So that's how we think about it. I think in terms of, margins, etc., honestly, there's no impact on that at all because I think, as compared to what we used to
Basically,
do.
we are moving from a non-fee led business to a interest led business. So I think there'll be impact on margins. There'll be reduction in ROEs for sure because you're consuming capital, right? When you're lending, you're setting aside some portion of capital towards capital adequacy ratio and all that. So I'm coming from that perspective.
Oh, this used to be there before as well, though, right? I think if anything, the only difference is before, honestly, like we were not happy with the kind of, I think, distribution setup or the partners that we had at some point in time, given their poor unit economics. And that's the frank reason why we never went about and, deployed the existing capital also that we had, because we just weren't confident that they'd be, these partners were, doing stuff which made, financial sense, very honestly, right, for themselves, because they themselves weren't profitable. And at the same point in time, I think there's no point building books which are not great, even if Apollo was financially covered, right? Which was actually the status, if I
I mean,
think.
I understand that FLDG regulations, forced you to pivot the change. I understand that. I mean, that's where you're coming from. So in terms of co-lending model, how do you look at it? I mean, what sort of ratio is, say, typically if a loan is for, say, 100 rupees, what sort of
Yeah,
participation will Apollo have with the NBFC?
we typically do an 80-20 where Apollo is the 80, right? And the opposite person is a 20. That's how we typically go about doing this.
Why would Apollo do a major part of the co-lending from their books? I mean, why would because origination is done by NBFC. And basically the credit risk is being undertaken by Apollo. I'm just trying to understand, how does Apollo look at this whole structure?
Yeah, so I mean, typically in any kind of co-lending, right? Like this is the way you think about it is, it's an industry standard, right? Like anybody who's typically doing co-lending, whoever is usually sourcing the loan ends up putting, a 20% into the loan essentially, right? And whoever is basically being, the partner lender, right? And so in these cases ends up, putting the 80%. That's, usually the industry standard of how things kind of go. Right. And from our perspective, the risk underwriting, everything remains exactly same as before, right? Because
No, there's a risk that the partner who sources the loan could end up giving, say, a bad credit to Apollo. His loss would be restricted to 20% of the loan that is being lent, and Apollo might be sitting with a higher portion of the loan.
no, not really, because actually what ends up happening is few things, right? Like number one is we haven't met a single NBFC, by the way, who wants to do any kind of bad loans on their own book, right? If any NBFC actually wants to do bad loans, it's usually in a BC partnership. Right. But very honestly, even in that case, we've never met an NBFC actually, frankly, who wants to do bad loans at all, to be, very blunt about it. But even if I had to, on
I'm
theory,
talking about when cycles change. Today's cycle is good. I understand nobody would look at lending bad loans. I'm talking more about, say, when there's a change in cycle.
but I'm not understanding essentially, right? Because it really doesn't matter what kind of loans that they want to do, right? Because finally the underwriting is controlled by me. So, if they end up sending me bad loans, we would just reject all of them.
Okay, so it's not a portfolio-led approach. It's an individual loan-to-loan approach. You're saying.
Absolutely, absolutely, right? Because see, essentially you have to do that, right? And any partnership, right? Like whenever we used to do partnerships even before, right? Like every single loan, it had to be approved by a policy which is jointly being decided, right? So as an example, I think the only difference right now is the experience for the end customer is really good, because what happens in certain cases is that, the sourcing NBFC, right, may come up with 100 loans. They may pass on 100 loans to Apollo, and out of 100 loans, maybe 50 of them are approved by Apollo and 50 are rejected, right? But instead of the customer being rejected, the 50 loans which Apollo rejected, the NBFC, which is the sourcing NBFC, directly ends up giving them the loan by keeping the loan 100% on their book, right? Because, if they are bringing a loan to Apollo, that means they've approved it, right? Now, the only question is whether Apollo approves it or not, right? If Apollo approves it, we'll put in 80% of the money. That's point number one. If we reject it, it's rejected, right? It ends up going to the sourcing NBFC, and most likely in our cases, we've noticed that they end up doing the loan on their book, right? Because they, as it is, want to source the loan and do the loan. I think the point number two is also the further benefit which happens from a co-lending perspective is that when we do 80-20, right, we actually take first round receivables on the entire 100%, right? So essentially this makes sure that from a commercial perspective, all the collections which are coming, right, the 80% and the 20%, Apollo has first right on that, right? So that really makes sure that, even beyond the credit policies that we set up, right, we also have further cover in the 20% that they have put in. And realistically speaking, right, like I think we haven't come across any NBFC who's at least done portfolios with us whose 30-day DPD numbers were anything beyond 7%, right? Because the math only doesn't make sense for them, and it becomes a completely loss-making proposition, from their perspective. While, we obviously have the 20%, which ends up being a first right round receivables that we take.
What sort of product are these? Last question. What sort of product? Are these unsecured loans or say consumer loans, or what sort of products are these?
So these are largely only unsecured loans, right? I think what we've kind of noticed is it's very difficult to do for us to actually at this point in time, do a secured lending in a large scale, because, by default, when you do secured lending, right, the cost of capital has to, obviously be much lower for the borrower. Right. So we've really not gotten into that space. While we are keeping an eye on it, if we find some, interesting product over there, which we feel is worth for us to obviously go in, learn and, do some pilots over there, we will. And we are actually actively looking at that space as well. We've evaluated as well 2-3 partners in that space whose, cost of capital matched what our expectations were, right? But so far we've not really found somebody who could do secured lending very honestly in a highly scalable manner using technology, right? Because obviously the ticket sizes there tend to be larger, and I don't know. So far we've not been able to find where technology could play a defining factor in secured lending, and the capital matching the rates that we are expecting.
Just a suggestion, and in terms of disclosure, probably, along with your single page details that you give out, you can probably disclose more things like number of loans, ticket size of these loans, NPAs, and typical all metrics related to the loans. Easier for us to understand where is Apollo growing and what sort of risk is Apollo taking. Today we are totally blind in terms of how the business is growing.
I hear you. This is a lot to do with us being, it's like, I think a few of the cons where I'm being honest, right? Like of you guys being investors in a public company, which also happens to be a startup, right? So I think the only reason why we don't do that, right, is strategic reasons, because if we display these numbers, right, obviously all the partners that we work with also understand very, very clearly as to what's the kind of contribution that they have towards their business, and it makes it a situation where they come back and negotiate harder for us, right? So we'll try and disclose as much as we can without it becoming a negative influence for the shareholders, essentially, right? Like, yeah, it's great to have all the information, but at the same point in time, because we are publicly listed, right, everything becomes available for everybody, and it becomes a competitive disadvantage sometimes for us to share a lot of this information. So we just have to keep that fine balance in terms of obviously sharing as much as we can, but at the same point in time, making sure that it doesn't become, just for the short-term benefit of seeing these numbers. We don't want to become, we don't want it to become a big problem for obviously the company to kind of, tackle and get the best deals out there.
Fine. Better, you can discuss whatever to the extent the competition allows you to, in terms of not getting the
Yes.
benefits of, that has been a long request from my side. Data disclosure is, we could probably increase the data disclosure for shareholders like us. I've been with the company since 2018. I've been very patient in terms of lack of data that being sent out. Anyways, all the best. We hope this new payment helps you go faster.
Thank you. Appreciate it.
Thanks.
Thank you so much, Mr. Mukesh. Thanks, Nikhil. We'll be taking questions from Mr. Naren. Mr. Naren, you can unmute yourself and ask your question.
Hi, am I audible?
Yeah, please go ahead.
My question is regarding the fee and commission expenses negative in both the quarters, quarter and the last quarter. Can I know the reason for the same?
Sorry, what was the question again? Can you please repeat? I think
the question was fee and commission expenses is negative in both this quarter and the last quarter. Any reason for the same?
I think let me just check on this. Okay, so I think I just checked with the team, right? So I think the answer on that is we had done some extra provisionings in the previous quarter. So I think that's the reason why it's negative.
Will it continue the same, or it will shoot up
No,
again?
we don't expect that trend to continue.
And what was the reason for that? Do you have any reason?
Yes, the reason was that we had made some extra provisionings, right? And that's the reason why basically, the numbers are shown up to be negative.
Yeah, okay, thank you.
Provisioning is usually an approximation, right? And that's the reason why, given the fact that we're a little bit conservative in nature, That's why we had done extra provisionings back then. But I think it's got reversed in this quarter.
Yeah, thank you.
Sure.
Thank you so much, Mr. Naren. If there are any other question, you can raise your hand. Further, we'll be taking question from Mr. Nitin again. This would be probably the last question. Mr. Nitin, I'll be unmuting you. You can speak now.
Nikhil sir, what's the culture at Apollo, and how is the compliance is ensured at Apollo?
Yeah, I mean, I think, to answer at least, both these questions, right? I think maybe I'll start with the compliance question because that's a little bit of a shorter answer. I think in any company, right, the thought process, I think it always comes from, what are we trying to optimize for, right? So like, I think whenever anybody tries to optimize for the short term, that's when you take a lot of shortcuts, right? And especially when it comes to, compliance, ethics and things like that, right? Like, I think if you want to build anything for the short term and you're looking to maximize short term profits, I think a lot of those things get, butchered along the way, right? I think for us, the thought process is always that this is like a very, very long term project, right? Like this company's existed for the last 35 plus years. It's going to exist like for the next, 100 plus years. That's how, we are building this. So, by default, it's not such a big thing for us to, basically, essentially, go on the conservative sides of basically compliance or ethics and things like that, right? To make sure that we're on the right side of history, essentially, right? So I don't think, that's something which comes at a very, very, big cost or in any kind of, it just our mindset is basically long term, right? So I think by default, by having that mindset, I think it helps us basically build with the right, right fundamentals, essentially, right? Like, I think so that answers that question a bit. I think from a culture perspective, what we try to do, right, is essentially we try to build basically, first, I mean, literally yesterday I was having this conversation with one of the team members, right? And I think, to me at least, what's the most important thing is number one is we obviously want to build, a great company, and a great company obviously is defined by, things like, phenomenal results and, year-on-year growth and things like that, right? But I think the most important thing for me is number one, like, building a company which has, people inside it which are happy, right? Which are happy inside it, and, where people are treated nicely, and at the same point in time, the teammates actually love each other and like each other, where, they enjoy working with each other, right? So I think to me that's like foundational, right? Once you have that, you combine that with like a really, really good team, which is, full of like, ambitious people, really smart people who want to achieve big things in life. Because I think you require that in any startup, right? Like, very honestly, I really strongly believe this, right? If you don't have a good team, most startups, right, are destined to fail largely because they're competing against players which are much larger than them, have much more capital than them, have probably more people than them, have more smarter people than them, right? I think the only way to beat, or to be successful as a startup is have like a really small team, go after a very specific problem, solve it really, really well. But, the team is the most important thing, right? And not, people keep saying it's important to have a smart team, but I think it's most important to have a happy team, right? A team which is actually, happy to work with them, work with each other, and has a positive mindset, and that can really change the game. Because that's how, one of the questions that we always get is like, how are you guys doing this with like 30 people, right? Whereas there are people in our industry who are, trying to copy us, who have like, I don't know, 300, 400, 500, 600 people, right? And they are struggling at this, right? And then the answer is this, right? Like, that basically we try and basically hire people who are really smart, at the same point in time, we most importantly hire good people. I think that's the first characteristic that we look for in people, that are they good human beings, right? I know sometimes people say that it's fine to work with people, who may not be, nice people, or who may be like me, really rude, but they're really smart, so it's fine. At least we don't have that mindset at all. Like, the first most important thing that we look for a person is this person like a good human being, right? If that person is a good human being, then we try to make sure that that person is smart. And then when that person comes in, we try and make sure that we are giving them the perfect environment to basically be super successful, right? Because our jobs basically, and every manager's job, I think, in life should be very simple. Once you hire really smart people and who are good human beings, just get out of their way and basically give them the right environment to succeed. So we try to do these things basically, right? And thankfully that's how magic always ends up happening. We built, I think, it feels like over the last 6, 7, or I don't know, 7, 8 years at this point in time, we built multiple teams, but every single time, we built a team, it feels like, the latest team always seems to be the best team, right? And I don't think that's an accident, right? That's just because obviously across us building this, we also learn about ourselves, we learn our strengths and weaknesses. We try to improve, we are also very, very young, right? Me and Diksha, like just 35, 36, that's very, very young for an entrepreneur. We have obviously a lot more to go. I think our team is also very, very young. At some point in time, we inside the company, we used to be people who probably the rest of the team had like maybe a 3, 4 year gap, age gap, right? But now that age gap has just become wider and wider, right? Where we sometimes now notice that gone are the days where we were interacting with people who were just 3, 4 years younger to us, but now there's a much larger age gap, right? Sometimes 10 plus years, right? But we sometimes forget that, right? Because we're just used to working with people, and honestly, it also shows the matter of fact that people who are much younger nowadays, if you find the right people, they are way, way more mature and they have a lot more knowledge and experience, than people used to be able to find before, right? Because I think the internet and, just people who want to basically be great, right? There's so many resources for them to kind of learn without actually doing a job that, sometimes they can come into a job really ready to go, right? So a lot of these characteristics are there. But I think, yeah, just to answer your question in one simple line, I think it all comes from, having good human beings who are really, really smart. If you have that, I think, all of the stuff like culture, etc., takes care of itself, essentially, right? That's how I'd kind of answer that question.
Can I ask you a last question?
Yeah, please go ahead.
Sir, how is the Apollo? You said one time that Apollo is very personal to you. How is that?
Sorry, can you repeat?
You have said one time that Apollo is personal to you. How is that?
Oh, because I mean, it's the most personal company I've done because obviously it's a company which was started by my dad, right? Like in the 1980s. So, this isn't like, I mean, I don't know how more to describe it, right? Like that's the most important thing. It becomes kind of like it's not only his legacy, right? But then now it's going to become, our legacy as well. So it's very important for us to obviously, do our best and, deliver, value to all its participants, right? Right from obviously, the team members to its, the shareholders basically have and to the partners that we have, right? We want to give, good experience to everybody, right? Because again, this isn't a company where, we're doing this for few years and, disappearing, right? This is going to be always there, right? So like, you want to do the best job you ever can because this is how you'll be remembered. So that's why it's very important, and that's why every time we do really, really well, it I think makes us me and Diksha that much more happier because again I think it's very nice to build on something which I think somebody that was very obviously important to me in my life has obviously built in his life. So if I can add to it and do a good job, that'll be really nice.
So in that stage that if you want to, as you are seeing a lot of startups that around you, will you take any stake in that, any startup that you think is it going to be multifold or something like that so that we can be benefited in Apollo?
Right now we are not thinking in that direction. I think, we one of the things that we try to do at Apollo is we do limited things, but we try to do it really, really well. The problem with doing those things, right, is I think you need a very different kind of risk appetite and different kind of mindset and different kind of skill set to do those things, right? I think Apollo is a debt machine, right, which happens to be really, really supercharged with tech, right? our tech is a differentiator that we can basically, leverage a very, very small group of people to do things which, 300 people also can't, right? In other companies. I think that's the focus area. We want to continue doing this. Honestly, I see so much scope in this space itself that I wouldn't want to dilute what we do and go and do, these other things, which very honestly, maybe there are other people who are much smarter than, all of us to do those things, right? I never want to dilute our vision or dilute like what we do. I rather be known to doing like, just one thing, but doing it amazingly well rather than, attempting 10 things and, being average at it, right? Like that's not the goal. We want to be amazing. We want to be great. And the price of greatness is focus, right? So like, that's how we think about it.
Thank you, sir. Thank you.
Yes. Thank you.
Thank you. Thank you so much. Wow, that was an interactive session. And further, if there are any questions from any of the investors, our team would be acknowledging it. You can drop a mail to our team on compliance@apollofinvest.com. So yeah, that's it. Thanks, Nikhil. Thanks, Diksha. I thank all the investors whosoever joined us. Looking ahead to more investor call in the coming quarter. Thanks.